Hey guys, I'm Santosh and I'm back with another interesting topic today. So today in this video, I'm going to share 8 points to become a profitable trader and to get that success in trading. Yes. So how people actually trade? People who are high risk takers and who want to earn some good amount of money, they'll prefer trading in stocks rather than indexes. And people who prefer indexes are those who are you know low risk takers. Now, in both the cases, the assumption is simple. Both the traders come to the trading terminal to place the order, assuming that the stock or index will go in some x direction, maybe up or maybe down. Based on that, they'll take a long position or take a short position in that stock or index. Now, how are you approaching to this assumption? Now, how are you deciding whether the index will move upward or downward? It's not in your hand. The demand and supply that you cannot decide, and the external factors and other internal news, we never know. We have to depend on few factors which will add some weightage to our assumption so that it will be successful. And the percentage of success should be higher compared to the percentage of failure. Only then will be considered profitable. In order to be profitable over a period of time, we have to take care of many things. One is we have to win big when we get a chance to win, and we have to cut the losses at a much lesser amount when we are when our trade goes against our favor. Now, and also we have to take care that our trades, out of 10 trades we should be making at least 6 or 7 trades as profits. And we need to keep the losing trades as minimum as possible, so that ultimately one can be sitting with profits even after deducting all the charges and transaction costs that are happening during the trades. Now, few things to keep in mind before you take up a trade. Let me start with the first thing. You need to identify the sentiment across the globe. For this, you have to go and check for the uh, global cues, especially US and European indexes like Nasdaq, Dow Jones, and S&P 500. And if you are trading in technological related stocks, then you need to look for the tech related index across the globe and European markets as well. So when you monitor these indexes, you will get some idea what's running across the globe, so that if the sentiment is positive or negative, you will get some idea. Only then you will think whether you want to trade today or not. Because don't come up with pre-assumed idea, thinking that the market will go up from now or go down from this level. No, that's not a right idea. If you are a trader, you have to be like a machine which takes some inputs and which will give some output. Now, if you want to act like a machine, you have to take some inputs either in the morning just before opening of the markets, or the day before that you want to trade. Now, keeping these points as an input, then you will think about the output. What could be the output? Now, output in the sense whether the stock index, the index or the stock will go upward or downward. You will get some clarity. And if you are also satisfying with the same assumption, then it's a good time to take up a trade. Now let me go through the other points as well, so that it will make you understand clear. Now, and just before the market opening, check the SGX Nifty, uh, whether is in correlation with the global cues or not. Now, why is this important? Because SGX Nifty is like our Nifty trading in Singapore exchange, so it resembles the same thing. Now, when SGX Nifty is indicating a negative, but all the global cues are positive, then now you are not clear. But when SGX Nifty is indicating some positive, maybe flat or slightly positive or a huge gap up, and also global cues are also supporting with positive sentiment, then it's a right time to make an assumption that there is more chance for the index or for the stock to go upward. Now, even if these two conditions are satisfied, you cannot conclude that the index will move upward or downward. And remember, whatever I am writing the points here, these will work mostly for indexes. For stocks, you have to do additional research, because stock, in the sense, a company, and a company, a lot of things will go on with the company. I'll talk about it in few minutes. And then next thing, uh, use only 30% of your capital for any trade. Don't use all of your capital, even if you are highly confident about your trade, because if if the trade goes against you, then you have to bear the consequences, and the damage that happens to your trading account, your capital, will be much higher. And in order to recover the damage, you have to spend a lot of time. So don't get into this trouble. Start with less, increase your capital, then obviously 30% of your increased capital will be again a higher amount. So think in that way. Obviously we want to earn a big amount, that's our human nature, but remember, earning consistent is actually very important to sustain in this markets, in this volatile nature of market. You have to be consistent over a period of 1 2 3 years, so that you will gain a lot of experience, and with that experience you can take a little more risk to get that extra reward. And always follow strict stop loss. If you think that 1% or 2% or 3% or 10%, whatever be the percent of amount, if you are losing and if it doesn't make any difference to you, then that should be your stop loss. For some people who are high risk takers, it could be 3%, 4%, 5%, but for low risk takers it could be 1% or 2%. And you have to end your trade then and there itself, and don't drag your stop loss thinking that your the trade will come back to your favor and it will give some profit. No, this doesn't work. Remember, when your trade is going against you, you have to accept the loss. And when you are starting to accept these losses, then this is the time you are actually building the experience as a trader. Because people who are having higher capital, what they do is they'll once their stop loss gets hit, they'll start doing ego fighting with the market. They think that uh, somehow the trade comes back in their favor, and they will get the uh, you know money back, so that they can recover their losses. Guys, only trade as a machine, don't trade with emotion. Once you start trading with emotions, then it is the time you are going to lose much higher. Disciplined trader only can sustain in the market, and only then he can earn some money. But people who play with emotions, they lose. They don't follow any kind of rules, even if it is right in front of them. Uh, some people, writes all the rules in front of their trading terminal, and they look and follow the rules. But when they face some losses, in order to recover their loss, then they forget the point of these rules and they'll start trading rigorously, so that they can they think that they will recover the losses, but in turn they'll face even more higher loss. So don't get into this thing, and always stick to one trade per day. And why is this important? If you're trading only for once, even if you're taking some profit or loss, you're ending the trading thing right away in the morning, or maybe below before afternoon, so that you can do your actual job. You don't have to put all your effort in making the money, sitting entirely in front of computer or laptop or mobile, watching the market, watching the green and red candle, and watching the demand and supply, and all the news running around, and thinking that you will make some money. And don't try to time the market can give you money and can take money from you. So always stick to one trade per day. If you let's say you have traded once in a day and you have gained some profit, then again why do you want to trade again to lose that amount? If you are getting profit, it's okay, you are making double profit in a day. But if you are losing, you actually lost the entire thing. And also you're giving some extra money in the form of transaction cost. Is it actually necessary? Why do you get into all this trouble? And then next important thing is, if you are trading in stocks, and some stocks whose business actually runs based on raw materials, then it's better to check the prices of raw materials, so that based on the prices you can take a decision. Let's say the raw material prices were increased last night, then today the company who works based on this raw material, obviously it's a negative news for the company, and you can go short on that stock. So check for the raw material cost uh, for specific companies to take better decisions. And then one more important thing is, always check the news happening around you. Now, what kind of news is this? It could be something related to war across the border, or something related to imports and exports, or some hike in the prices, or news related to inflation, or news related to monetary policy committee, or anything related to politics, a big change in politics, or anything related to health. And especially during this corona, we have seen a lot of volatility because of the panic that corona brought to the market. Things like this are actually important, and this can change the entire game of trading. So uh, better keep all this news handy, so that you will either, you know if you are very confident the news is negative, then you can go short on the index. But if you are not understanding how this can impact stock market, or how stock market takes this news, then it's better to stay away from the uh, s- uh, you know uh, stock market on that day. And one more thing, monitor stock specific news, only then take the trade. This is important because if you are willing to take a trade on stocks, then you have to see if there is any upcoming news, or if there is any news already happened, just before that day, or very recently. Then if there is such news, it's better to stay away from that stock, look for another stock. But if you are if you are more interested in one particular stock, then try to understand the impact of the news. Generally, all the stocks trades with respect to the future. So let's say you are anticipating that a company will deliver high performance in the results. And now this time the company may deliver high PAT, high EBITDA, high revenue, everything will be good. And now what? You have seen this news today in the morning, and you have gone long in that stock, but surprisingly, most of the times you will see loss in your trade. You know why? Because this is the news that many of the people are anticipating from way back, maybe 10 days back or 20 days back. This news started in the market related to the company, so many people started buying way before than you, and they have started that rally, and now the stock rallied maybe 5% or 10%, and at this level you are entering here. Now what they do, they will book the profits and they'll come out of the trade. In the process of booking the profit, it means there comes the selling pressure, and obviously the stock price goes slightly down, and with this downfall, you'll obviously see the loss. So stock market works based on future news. So market anticipates, expects something in the future, so based on that all stocks and indexes run. So yes, I think I have made all the points clear, and remember, follow these things every day in each and every trade whatever you take for almost 2 to 3 years, and stick to this plan. Then definitely you will be sitting with high profits at the end of second year or third year, and then with that experience you can take your trading journey to a next level, so that your return on investment and your profits and everything will be high. uh, yeah, so I hope you all understood what I meant, and if you still have any questions, please put them in the comment section below, and if you haven't subscribed to my channel, then please consider subscribing. Thank you.